2018 Pennsylvania Tax Update, the State Budget, Legislation, and Multistate Tax Planning, was a live webinar that was originally produced on Thursday, July 26, 2018. For this webinar, we were joined by two of our team members here at McKonly and Asbury, Mike Eby and Lindsey Waltemyer. We hope you enjoyed this recap, and please visit us online at www.macpas.com for more information about other future webinars and all upcoming events.
Well, thank you, Dan. Just want to take a moment to welcome everybody to today's webinar. Specifically, we're going to talk about Pennsylvania taxes, but we do have a lot of other areas to cover. We're actually starting to finally get some sun here in the Harrisburg area, so I do appreciate everyone who's decided to stay indoors and listen to us as we speak today. This is actually the first year in a while that we've been able to discuss an enacted Pennsylvania budget. The budget's usually the main topic of these presentations, and usually then have to, when we do it in July, have to talk about the proposed budget because there's not an enacted budget yet, and then we try to fill in the blanks from there. But in fact, this is actually the earliest budget that's passed in Pennsylvania since the Tom Ridge era back in the 90s. So we're going to talk about a few factors of why that was. But just a little bit about us as presenters today. Again, my name is Mike Eby, and I lead our state and local tax practice here. I've been a member of our practice for about 11 years, and I'm working with my presenter today and colleague, Lindsey Waltemyer.
Yeah, my name's Lindsey. I have been with our SALT group for 4 years now, and I am a supervisor on our tax team.
And we focus our practice here on several areas, mainly identifying tax savings opportunities through refund appeals, but also spend a good amount of time working with our clients through their audits and going through appeals related to those for various state tax types. So taking a look at our agenda today, it is pretty crammed. We're going to have to go quickly through a number of these topics, particularly some of the ones in the middle there that are definitely the first time that we've had to go into this type of territory. But the first topic, and the enacted 1819 budget, surprisingly, there's not a lot of things from the tax side to talk about with the enacted budget, but we'll discuss those. We'll then take a look at some of the more recent Department of Revenue publications and some of the procedural changes there. And then also discuss proposed tax legislation for Pennsylvania, as well as the Nextel case from last fall. Next, in case you haven't heard, we've had this little thing back in December called federal tax reform that passed. And as accountants, we're still trying to get our heads wrapped around all the changes at the federal level. We're still waiting on regulations to be published by the Treasury Department to understand really what are all the implications on the federal side for tax reform. But there's a whole other ballgame to this, and the fact that we have to figure out for states how are they going to react to the federal tax reform, and oftentimes corporate income tax and pass-through such as S-corps and partnerships fall under personal income tax rules. They've been quite different. So there's a lot of things to factor when we think about federal tax reform as it relates to state taxation. After that, we'll move into the monumental U.S. Supreme Court case that came out last month, Wayfarer versus South Dakota, and Lindsey's going to take us into a little dive into some of the facts and on that, and specifically how it's going to affect businesses across the country going forward. And finally, if we have some time left over, this is one of my favorite topics each year. How does Pennsylvania's tax structure compare to other states? The annual Tax Foundation rankings that are released each year provide some insight into that, and we'll take a look at how Pennsylvania stacks up to its neighboring states. So, as I said, full agenda. Let's dive right into the state budget here. You can see if we look at the general fund numbers there's the last year's budget on the left, the one that most recent completed year, and then the fiscal year 1819 budget on the right for the year that we just started. You can see a small increase in the general fund budget, about $700 million compared to last year. And, depending on who you talk to, the actual spend ended up being closer to 32.9 in last year. So some people would probably spend this as a revenue or spending decrease this year, but the enacted budget that passed last year was only $32 billion. Oftentimes we're focused on that general fund budget, so you hear $32 billion thrown out mostly, but the total budget for the Commonwealth is actually $84.5 billion. You have other funds, which include motor license fund, the lottery fund, the tobacco settlement fund. And if you recall back to last year, we had to take a $1.5 billion transfer from the tobacco settlement fund into the general fund budget to balance that. And then it also includes the property tax relief fund. For the designated federal funding each year, there was some concern over the past year that with federal tax reform, the discussions on that there would be corresponding cuts to federal funding that has not taken place yet or has not occurred. And we're actually up $900 million for federal funding compared to prior year. So this slide talks about where does Pennsylvania actually receive its revenue as a percentage, making up that 32.7 budget for this coming year that we're currently in. You can see the two biggest tax types by far are personal income tax and sales and use tax. And both those tax types had increases this year relative to the percentages as a whole. They're up to around 73% combined between the two, and that's not uncommon as you look at most states across the nation. Those are the two leading fund getters. Typically, the easiest ones too if you were to raise or broaden the tax base in either of those areas to close budget shortfalls. However, they are the most politically charged ones and difficult ones to get changed because almost every Pennsylvanian is directly paying each of those two tax types. So other taxes end up getting focused, like corporate net income tax or other taxes types such as the severance tax. Rounding out the pie chart there, we have other taxes, which is made up of bank shares tax and motor fuels tax as an example. And then we have a separate category for corporate net income tax. Again, it makes up a pretty small portion of the overall budget and not uncommon as well for that to be the case in most states. The only issue here with Pennsylvania is that it's a 9.9% flat tax rate, which is the highest flat tax rate for corporations in the country. So we're not competitive in that area, and it also makes up a relatively small portion of our budget. Cigarette tax is actually down as a percentage and down in terms of expected revenue by $200 million. The interesting thing about that is that there was a $1 per pack cigarette pack increase 2 years ago with the fiscal year 17 budget. So for it to go down, common sense would tell us that there has been a decrease in the amount of smokers, or they're decreasing the amount they're actually spending for cigarettes at this point, or maybe to a lesser extent finding different avenues to purchase outside the Commonwealth. For the governor's proposed budget, a lot of things did pass from what he had proposed. He proposed a $33 billion budget, which is the final one that came in about $300 million, less than that. But he asked for new investments in public education, which did go through, and we'll talk about those. He asked for an increase in investment to address the opioid crisis that's affecting Pennsylvania and many other states across the nation. And he did get the $5 million increase in funding for that to allow visiting agencies to go into homes for families that are affected by that crisis. He asked for an increase in minimum wage, which of course did not go through. The current federal rate is $7.25 per hour, and he was asking for a raise to $12 an hour. And probably no doubt there's a lot of movement in that area that this might be a potential budget item on his proposal next year if he does remain to be the governor. There were no broad-based tax increases, no tax rate increases, or broadening of sales and use tax, for example. He did propose going to combine reporting for corporations starting in 2019, and that's the same for all his budgets that he proposed. The intent here is to close what is known as the so-called Delaware loophole. And these are for businesses that pay tangible expenses to royalties or interest to related parties in Delaware that hold their patents or hold loans. You do have winners and losers with combined reporting because it would be bringing in businesses that aren't filing in the state because they might not have nexus. However, it's also bringing in companies that might not have any activity in Pennsylvania, and it's watering down maybe the state apportionment of taxable income that's apportioned to Pennsylvania. Or you're also bringing in loss entities that are lowering the overall net income. And if the combined reporting were to have gone through, he was asking for a reduction of the corporate net income tax rate. Again, as we said, it's the highest flat tax rate in the nation, just under 10%. And that would have been starting 2020, and with a full phase-in at 2023, which would have brought the rate down to 7.99%. But with combined reporting not going through, that also did not go through. And then the natural gas severance tax, he's been asking for this each of his 4 proposed budgets. He had a $250 million approximate line item of revenue for that. A lot of signs are pointing, though, that this is each time gaining more bipartisan support. So very likely it'll be on a proposal next year and might have a chance of actually going through at some point pretty soon. So to reiterate again, no major tax increases or broad-based tax increases or expansions. So what actually did go through? House Bill 2121, which became Act 1A, and then the Fiscal Code, which is House Bill 1929. The Fiscal Code is kind of like the spending game plan for the Commonwealth. That became Act 42. Mostly reoccurring revenue. Again, we didn't have the significant transfers like we did last year to budget, or to close the budget. That was a shortfall. That was almost $2 billion at that point, bringing 1.5 of that from the tobacco settlement fund. There was increases in education spending, like we talked about. Basic education received a $100 million increase. There was a 3% across-the-board increase to higher education, and then special education received a $15 million increase. $30 million increase was designated to the governor's PA SMART program. This is the STEM career job training initiative of his. And then $25 million increase to the EITC program, which we'll talk about in a few minutes. The last item there, the $2.8 million transfer to the rainy day fund. Some people might not even know what that is because it's been a while since we've been able to put funds into the rainy day fund for the Commonwealth. State law requires that any surpluses in the operating budget, that 25% of that be put into a rainy day fund. The legislature decided to actually transfer 50% this year, so they're budgeting for just over a $5.6 million, which is relatively small surplus in this year's budget. So hoping to put 2.8 into the rainy day fund. But for this most recent budget, or most recent fiscal period that closed June 30th, they were actually able to transfer $22 million from a surplus in prior year's budget to the rainy day fund a few weeks ago. And in 2 years from now, so the 2019-2020 budget, they're projecting to transfer $74.5 million into the rainy day fund. The 2 tax items, or tax-related items, that were in this year's budget were related to the bonus depreciation fix, Act 72, and then the educational improvement tax credit, some program changes with that. The bonus depreciation fix was a big one. Just to give some background on that, as we know, December 22nd, the federal tax reform passed, and that allowed for 100% bonus depreciation on qualifying assets, and that was retroactive to assets that were put into service anytime after September 27th, 2017. The Department of Revenue was really on top of this because the very next day they released Corp Tax Bulletin 2017-02. And Pennsylvania has a very funky way of calculating bonus depreciation for corporations, and this is only C corporations. Pass-throughs such as S-corps and partnerships don't fall under this because they fall under personal income tax rules. But for C corporations, there was a 3/7 add back, and just kind of some quirky ways of how it was calculated. But because of that, the Department of Revenue took the position that if you took 100% bonus depreciation on your federal return for an asset, that asset would receive no Pennsylvania depreciation, not just no bonus depreciation, but no regular maker's depreciation any year, and the only way you would recover the basis of that asset is when you actually disposed of that. Of course, very unfriendly publication to the business community, and rather unique because people were expecting something like this where bonus depreciation would not be allowed, but to say that no depreciation whatsoever would be allowed on these assets was entirely unfounded. So it was actually a 180 from Department of Revenue's interpretation of it back in 2010 and 11 when we did have federal 100% bonus depreciation at that time. They interpreted at that point that PA would actually, for C corporations, follow 100% bonus depreciation, meaning for both federal and PA, you were able to write off the asset the very year of purchase. It was a little different story this time with federal bonus depreciation being extended for 5 years. It was going to present some challenges for the Commonwealth from a timing standpoint of if they were to allow corporations to write off all their purchases from that were qualifying for bonus over the next 5 years. So the state legislature had intended to pass a fix for this issue back in the spring, but failed to do so. It did, of course, pass along with the budget as part of that session. And then the Corporate Tax Bulletin 2018-03 was released by the Department of Revenue to clarify that. And there was some confusion by some in the business community. This fix does not mean that Pennsylvania follows 100% bonus depreciation. It's still an add back. But now the new law will allow you to purely decouple from federal and take normal maker's depreciation each year and be able to recover depreciation during the life of the asset instead of having to wait until it's disposed of. And then the Educational Improvement Tax Credit Program, a very popular program in Pennsylvania, and I know a number of our listeners, their businesses have taken advantage of this over the years of this program. There was a $25 million increase, and it went all to the scholarship organization section of that program. That was the program that had the most demand, according to DCED. And that program is now up to $160 million in total funding. And when it started, it was about 120 less than that. So you can see how popular it's become. Some other just items there of changes. There's now a requirement of businesses to notify the DCED within 14 days of an award letter if they're going to be committing to contributions of 50% or less of what they're awarded. And the reason behind this is that this gives the DCED more time now to act if they are going to have more funds available, and they can go on the waiting list for businesses that weren't approved and start sending out award letters to those on the waiting list. Before, it would be almost a 75 to 90 day turnaround before they were notified of that. Returning applicants that come back for a preferential return date, they can apply early for May 15th. Opposed to July 1st for new applicants. If they're coming back and taking advantage of that new date, they need to apply for the same program within EITC. And there are a couple due date changes for charitable organizations that are recipient organizations on the list of qualifying for the EITC. So I encourage those organizations to take a look at that. And I would offer as well, if any businesses out there that are interested in participating in EITC, certainly reach out to us. Our contact information's at the end of the program, and help a lot of clients with that application process each year, as well as determining what an appropriate amount would be to participate in the program, depending on their tax liabilities. So we talked about this being a pretty easy state budget relatively to pass, and obviously with it passing so timely. Why was that? Well, it was an election year, which usually helps, not always, but it looks good for the incumbents to be able to pass a state budget and have their act together in that way. The fact that collections were meeting or exceeding expectations for many different tax types, and as well as just a lot of projected growth for the Commonwealth. You can see there in those sides, real GDP for the Commonwealth is projected to increase 2.3% in 18, and then another 2.2% in 19. We've had a lot of increase in employment. 62,000 new jobs were added in the Commonwealth in 2017. And then just overall increases in Pennsylvania wages, 3.3% in 17 and another 4.3% in 18. So that said, a good economy really makes things a whole lot easier to budget for. So that's the budget this year. We're going to stay in the mode of reviewing some Pennsylvania tax updates by taking a look at Department of Revenue updates, some proposed legislation, as well as the Nextel case. I've gotten so many questions on this first topic this last 6 to 7 months when it originally was becoming effective. The 1099 withholding requirement for Pennsylvania. Probably, and as I said, probably in any time that I've spent over the past 11 years in this practice, I don't think any one particular issue has drawn so much attention as this particular issue. It was originally, as I said, effective January 1st, 2018. Through the PICPA State and Local Tax Committee, which I'm a member of, we did petition to the Department of Revenue. Let's push this back an entire year to give businesses a chance to understand the law and become compliant with their internal processes. Department of Revenue met us halfway and extended to July 1st, 2018, which I do believe certainly helped a lot of businesses. So what I recommend when going through these conversations, the merits of this program were good. The legislature had good intentions here. They're trying to draw in non-compliant taxpayers that live outside the state and make them pay Pennsylvania income taxes that they actually do owe. However, the burden, the bad part here is the burden that is really falling on Pennsylvania businesses here from an administrative standpoint. But I encourage businesses, they start with their federal 1099 reporting process and then eliminate down from there. And in most cases, I found that there are very few situations where the withholding was actually required for our clients. The withholding is only going to be on PA-sourced payments, meaning even though you're a Pennsylvania business, if the work that you're hiring to have performed is being done in a state outside Pennsylvania, that would not be a PA-sourced payment. So we can eliminate down from there. Payments to non-resident individuals or trusts or single-member LLCs that are included as individuals are what this is required on. Whereas for the federal side, 1099 miscellaneous forms are required for partnerships as well, but not under this PA 1099 miscellaneous withholding. So there's another factor that we can eliminate there. Programs also, if you're paying rents to a non-resident landlord as well, over $5,000 a year, and doesn't matter if you're paying these to a management company. It's based on who the landlord is. So in some cases, you might not necessarily always know where the landlord's based. So that's something that you would have to figure out. And then required payments, it's only if you expect to pay more than $5,000 a year to any one recipient. Again, at the federal level, it's only $600 threshold before you have to issue a 1099 miscellaneous. But this was kind of the grayer issue of the law because it's who's expected to exceed $5,000. Let's say if you ended up paying more than $5,000, but really when you started out, you had only expected to pay $3,000, and therefore were not withholding along the way. Originally, Department of Revenue was saying, well, withhold as soon as you think you're going to meet the $5,000 limit. More recently, they've come out with the position that you should do a catch-up withholding payment on your final payment to that takes you over that $5,000 limit to that recipient. It sounds like the Department of Revenue is not going to really enforce that in 2018 on businesses, but they are definitely going to enforce that more rigidly in 2019. So let's say if you had only expected to pay $4,000 during the year, and you didn't withhold on that. If you then pay $1,500 to that same payee on your final payment, you're going to be having to withhold on the equivalent of $5,500 on that final payment. So you won't have to go back down and trace these payees for previous payments. It's only if you then make a payment that exceeds that $5,000. There is a withholding exemption form, Rev 1832. It's not required to maintain, but probably good process, internal process to have, particularly if you're sending out W-9s. If you're expecting PA work to be performed as well, send out the Rev 1832 for your files as well. And the Department of Revenue has a really good website that they put up that's kind of the all-inclusive 1099 withholding information, which has a lot of commonly asked questions on there. I encourage you to check that out on the Department of Revenue's website. The popular R&D tax credit, that application is moved fully online now. That's to allow the Department of Revenue to process the applications quicker and then get award letters out based on the amount of applicants and available funding for the program. The Department of Revenue and PICPA did a joint webinar on that a few weeks ago to discuss how the application works. I encourage you to check that out on the PICPA's website. That's an archived webinar now. Department of Revenue is continuing with their modernization project, updating their software for processing of tax returns, and that began May 14th, and it's going to be entering again into multiple phases with different tax types being introduced in each phase. Personal income tax being the final one. Fast Enterprises is the vendor that's performing this. They've had successful implementation in a number of states of their software, and so they're very reputable in that area. Department of Revenue is also continuing the trend of more transparency with information for practitioners. 2 years ago, they allowed practitioners to start registering and being able to access statement of account information through their eTides account. And as most recently, they now allow you to sign up to receive any correspondence that's sent from the Department of Revenue to your client, that you would be actually getting a copy of that as well, which certainly helps us be able to kind of see issues even before our clients are able to pass those along to us. And then Wayfarer, we'll talk about that, of course, more later, but the Department of Revenue is anticipating releasing a bulletin on that very shortly.
So we don't have a lot of sales tax updates for Pennsylvania, but effective May of last year, Pennsylvania enacted a tax on information retrieval products. These are products which allow a user to pull in a query to pull up information. It's something that affects us here as accountants because it would include the programs that we use to do tax research. So anything like that where you're putting in a query in order to get information. The second point there clarified SUT 17-001, which enumerated certain taxable software services. PA clarified that help desk or call center support is exempt when it's separately invoiced.
Some proposed legislation, as I said, 1099 miscellaneous is a big issue for the business community right now. There's 2 bills out there proposed, the one by Frank Ryan, 2020, House Bill 2027, which will eliminate the requirement altogether, which sounds like a good idea, but most likely won't have a chance to go through. That is a decent revenue item for the Commonwealth. But House Bill 2413, offered by Keith Greiner, provides some technical corrections in law and some clarifications as it relates to the thresholds. With it, has a better chance of going through. And then House Bill 2303, this would bring Pennsylvania into conformity with the IRS, their federal treatment of, in the year of death, allowing estates and revocable trusts to make an election to file a single return. And that's House Bill 2303. The only, I had 2 court cases, but the main one that I wanted to discuss is the Nextel case from last fall. This was a very highly anticipated case dating back several years. In 2014, the Commonwealth Court ruled in the favor of the taxpayer in this case, Nextel. It allowed them to have a $4 million refund for their 2007 tax year because they were restricted on how much net operating loss they were able to use. See, in Pennsylvania, up until last year, you were able to use the greater of $5 million of your net operating loss or 30% of your taxable income. And for most businesses, in fact, 98% of them, they fell under the dollar cap, so they were able to eliminate their entire net operating loss, eliminate their entire net income for a given year. Nextel said that violated the state's uniformity clause by discriminating against larger taxpayers who were unable to negate their entire taxable income because they well exceeded that $5 million dollar cap. So fast forward to 2017, the state Supreme Court agreed with the Commonwealth Court's decision, but they disagreed on the remedy. So they did say that the dollar cap NOL was unconstitutional and struck it down in its face, but they didn't give Nextel the refund either. I think the real concern coming out of this was, could the Department of Revenue, if this was unconstitutional in its face, for the many taxpayers that did take a net operating loss below the dollar cap limit, could the Department of Revenue go back and actually assess for open years on this? And immediately the Department of Revenue didn't quite show their cards on this. They were saying they were going to evaluate that. But just this past May, they did ease taxpayers' minds by coming out with Corp Tax Bulletin 2018-2, saying that they're just going to prospectively apply this for years starting in 2017. So just an important important thing to keep in mind: any C corporation that has net income in a given year, they will be paying taxes now. Whereas before, if they had enough net operating loss, they could have wiped out their full taxable income in the given year. One last note there: Pennsylvania did in their budget last year anticipated this type of decision related to Nextel, so they increased the NOL percentage from 30% to 35% in 18, and then another 40% in 19 to help mitigate some of the burden on the smaller taxpayers that will no longer be able to use the dollar cap. And hopefully that percentage continues to rise each year with something else that's passed. One case that's not on there, just passed last week, was the PA Supreme Court upheld the Philly beverage tax that was enacted in 2017 with placing a 1.5 cent per ounce surcharge tax on certain beverages sold in Philadelphia. Supreme Court decision said there's no duplication of tax in this case because, yes, the consumers are paying sales and use tax on their purchase, but the soda tax is actually enacted on the distributor or the dealer in this case. So there is not two taxes being directly placed on the consumer, although we know when tax is on a business, it does ultimately get passed down to the consumer.
So, as Mike mentioned previously, there's been a lot of discussion about federal changes related to tax reform. So we wanted to go over a few of the changes that have an impact on the states and how those federal changes are going to impact state taxation. Before we talk about specific changes, I wanted to do a quick overview of how we determine the state effect of federal changes. The two main factors that drive this are the starting point of state tax and the conformity to the federal tax code. So looking first at the personal income tax chart on the bottom left, you can see that PA is one of the few states that has their own state gross income. There's no federal starting point, but instead PA uses their own calculation. Sometimes we refer to that as the 7 buckets of income that PA uses. This means that the federal law changes will be less likely to affect PA than other states that have a federal starting point. We will see later that whether a state starting point for personal income tax is federal AGI or federal taxable income will affect whether a state naturally conforms to federal deductions which affect taxable income but not AGI, such as the new Section 199A deduction. The charts on the right show state conformity to the federal tax code. States with rolling conformity, which are those in green, the light green, will conform to the federal tax code currently in place, whereas states with static conformity will conform to the federal tax code as of a specific date, and that date has to be updated when new laws are passed. So certain states right now might conform to the federal tax code as of 12/31/16, which means they would not conform to the current Tax Cuts and Jobs Act. In the top right-hand chart, you can see that PA does not conform to the federal tax code since they have their own personal income tax calculation, whereas the chart on the bottom right shows that PA uses rolling conformity for corporate income tax, like many other states, which means they do naturally conform to the Federal Tax Cuts and Jobs Act for corporate tax.
I thought this chart was an interesting one that Ernst & Young published earlier in the year. A lot of the attention was on tax reform was the corporate tax decrease rate in the rate from 34, effectively the highest rate, to a flat 21%. But in order to accomplish that, a number of deductions had to be eliminated or reduced. And thus, with states that are following federal starting point for their corporate income tax, that automatically would increase their taxable income base. See things like the 30% interest limitation, removal of domestic production activities deduction, some of the foreign tax provisions, and maybe even to a lesser extent, entertainment expenses being no longer deductible. You can see the overall change there. On average was about 12% increase in the taxable income base for corporations. Pennsylvania is one of the higher ones there at 14%.
So I won't get too into the Section 199A deduction because we could easily talk about those rules for the entire webinar. As many of you know, this is one of the bigger changes to the federal tax code. But basically, there's a 20% deduction allowed for pass-through income, which is subject to various limitations. The key here is that The deduction reduces federal taxable income, but not federal AGI. So if you notice the chart there, only the states in orange have a starting point of federal taxable income. So it's only a few. And those are the only ones that would follow this deduction by default or without additional legislation being passed. There are a few examples there, such as although Iowa uses federal AGI as a starting point, and it's there in the light green, that would not include the deduction, but Iowa has a proposal to allow a partial deduction of 25% of the federal amount, which would actually then increase over the years. Colorado, Idaho, and North Dakota are all in orange in the chart, indicating that they would naturally conform to the deduction, and they have not decoupled, so they will follow that, assuming they don't pass additional laws. Oregon is in orange in the chart, so naturally it would follow, but it is expected to decouple from the rule. And finally, Maryland and South Carolina start with taxable income, so again, they're in orange, but they have not updated their conformity. They're states with static conformity, and they have not updated to the current tax code, which means they are not going to follow the deduction unless they do make that update. And then we also can talk about the previous Section 199 deduction. This is now repealed at the federal level. Previously, there was a deduction allowed for domestic production called the Domestic Production Activities Deduction. And the states in yellow on the chart conform to the DPAD, which means they allow the deduction at the state level. PA was among those that conformed at the corporate level. So along with the other states, this is a base expansion for PA because there's no longer this deduction available, which means PA residents or PA taxpayers do not get that deduction now, and the base is expanded. For the limitation on interest deduction, per federal law, interest expense for corporations is limited to interest income plus 30% of adjusted federal taxable income. Since the interest limitation is taken into consideration in computing federal taxable income, most states which conform to the Tax Cuts and Jobs Act will conform to this change. One thing to note is the small business exception. There's a $25 million gross receipts test, which is average annual gross receipts over the past 3 years. So regardless of whether states follow this limitation or not, if your business falls below that threshold, it doesn't matter and it won't affect you. As you can see there are 9 states that do not conform by virtue of static or no conformity. And then the 5 states below that specifically decouple. They would naturally follow, but they decided that they want to decouple from 163J and will not follow it. And then as a rolling conformity state, Pennsylvania does conform to the interest limitation and has not decoupled from that. There's also a potential issue here regarding consolidated returns. States may do a separate 163J limit on a standalone basis, which could be an issue. So think of a consolidated return. At the federal consolidated level, there may be an interest expense, but then there is generally income that will raise that limitation and allow the corporation to take the interest expense. Now think of a holding company within that consolidated group, which has no income but holds the interest expense. There's an issue there if the state requires the limitation to be calculated on a standalone basis, since the holding company limitation would be 0 because they have no income, and the full interest expense would be disallowed.
You know, Lindsey, I think, this good example here of what's of a lot of unknowns still and how states are going to handle this. As an example, for the federal level, if you have a real estate company or a farming company, they can actually elect out of this interest limit deduction, but then they're not allowed to take bonus depreciation. And the interesting thing, most states don't allow bonus depreciation anyway. So is it fair to kind of get a kind of double whammy here where they're limited on how much interest they have and they're not able to take bonus depreciation? So a lot of our determinations here, and we don't know, but a lot of our determinations here, they're based on how the state traditionally has conformed to the Internal Revenue Code. But we haven't had such wide-sweeping tax reform in years. So a lot of these things that we would traditionally say, well, the states are going to conform or not conform to this, they're still up in the air depending on how the state's legislature is going to address each one of these for each respective state.
Right, and that's a lot of these provisions. There's a lot of items here where it's essentially a waiting game at this point. We're just waiting to see what the states are going to say about these different rules and how they're going to do their own calculation. So along the same lines, I wanted to touch on this interest deduction limitation for partnerships and S corporations. So the first thing to note is that it is the same limit. It's considered in computing non-separately stated income or loss or ordinary business income on Form 1065. But it's that same limit of interest income plus 30% of adjusted taxable income. Certain other rules do apply related to pass-through entities to prevent unfair circumstances. One of the differences is that excess interest expense is not carried forward at the entity level, but instead allowed to each partner, deductible in future years only against excess taxable income from that partnership. That applies to partnerships, though, not S-corps. Regarding the state treatment for pass-throughs, since the limitation is included in ordinary business income, we would expect that most states, including PA, will conform just simply because of the way it works. One other thing I wanted to mention, and we don't have a slide on this one due to some recent developments, but one other notable limitation is the limitation on the state and local tax deduction at the personal level, and this is on itemized deductions. The Tax Cuts and Jobs Act limited the deduction for state and local taxes to $10,000. Recently, there are 4 states, New York, Connecticut, Maryland, and New Jersey, that have actually sued the federal government over this deduction cap, asserting that it violates the U.S. Constitution by interfering with the state sovereign authority. And we've also seen other states that are trying to make rules to get around this.
Sure. I mean, I think some more of the, what I would say, legitimate ones, Connecticut, more recently for their pass-through businesses, they're no longer going to be having that tax paid by individuals. They're instituting an entity-level tax starting with this year. Business taxes, of course, are fully deductible still. There's some ones that states are creating very unique workarounds. California, for instance, has this excellence fund that's basically a quasi-government fund that established for education that taxpayers can donate to that fund and then get a corresponding 85% tax credit on their tax returns, essentially lowering the amount of taxes that they have as a deduction for their federal, but increasing their charitable contributions, which are not limited yet. And a number of states are kind of jumping on this idea, and the Treasury Department is expected to release something related to this, an interpretation on their part that this is not going to be allowed. The concern, though, is that there's been a lot of credit programs. We talked about the EITC before, how popular that is. You get a 90% tax credit. That's the main draw to the program, but your donation's also tax deductible. And if now, and with a corresponding add back of taxes because it reduced your state taxes. But for taxpayers that were in AMT, that was a big advantage for them to have charitable contributions in the past. But even going forward, that if that's struck down because of what these other states are kind of doing with this, their unique workarounds, that it's going to hurt these programs, the 100 or so programs that are in 35 different states that have already had this process in place for a while. And it's been backed up by case law that this is a true deduction. But what's the saying? Pigs get fat, hogs get slaughtered. So some of these states are certainly taking advantage of it in what I would say is probably not the right manner. Net operating loss deduction, federal, the NOL deduction going forward for any NOLs that are originated in 2018 and beyond, they'll be limited to 80% to be able to negate taxable income in the future years. NOLs originating before 2018 won't be limited. Pennsylvania, as we said, already has their own limitation. It's 35% of taxable income for 2018. You look at the bottom there, the effect on other states, probably not going to directly affect many states. 16 states add that back, the federal NOL. 25 states start with federal taxable income before NOL, including Pennsylvania. So right there, 41 states aren't going to directly be impacted. So I don't see the NOL deduction being from the federal level being a major effect on states.
We wanted to touch on the Repatriation Transition Tax, or RTT, partially because PA issued an information notice on the subject describing its effect on PA income. Now, the RTT includes both a tax on untaxed E&P of foreign corporations accumulated after 1986 and prior to 2018, as well as a deduction related to the repatriated income. The RTT and RTT deduction will not be included in federal taxable income before special deductions and the NOL deduction, but instead are reported on a separate statement with the net tax shown on Schedule J of Form 1120. And those of you that aren't versed in schedules, that's just the tax computation for corporations. Taxpayers may elect to pay their RTT over 8 years for federal purposes. For Pennsylvania, they've noted in the information letter that the RTT income is subject to corporate net income tax, and the deduction is included in determining the state tax base and reduces the RTT income. And PA also does allow a dividends received deduction, which is an additional deduction for corporations that receive dividends from a foreign corporation, and that's referred to as the PA DRD. For personal income tax, the deemed dividend upon distribution is not taxable until actually distributed. And one other note, most Pennsylvania taxpayers are not allowed to defer the RTT income over 8 years like they are for federal. I would definitely recommend checking out the information letter on Pennsylvania's website if this is something that you believe might affect yourself. Or feel free to ask me or Mike. Our contact information, again, will be shown at the end of the webinar.
So full expensing, that's the last provision we'll talk about at the IRS level or the federal level. For bonus depreciation, taxpayers can now write off 100% of the cost of assets that qualify after September 2717. Another big issue or big deal for that is that it was only eligible for brand new assets before. Now, previously used assets are now eligible. So the qualifying base of assets has really been expanded. And then Section 179 deduction, which is similar, but for smaller and medium businesses only that it applies to. It's increased the deduction available in any given year from $500,000 to $1 million deduction. And reasons for small to medium-sized businesses is that the phase-out is removed or not allowing the deduction when $2.5 million or more of qualifying assets are placed into service in any given year. And this data and these thresholds are adjusted for inflation each year. So just a quick summary here on the federal tax reform impact on PA, summarizing what we talked about. Very little impact. A lot of the individual items in tax reform were related to deductions, specifically itemized deductions, which Pennsylvania has never allowed. They allow very few deductions on the tax return. So that also Section 199A deduction would not apply. And with full expensing, do they follow that? No. Because for personal income taxes, which again, partnerships and S-corps would fall under that, Section 179 is limited to $25,000 each year, and bonus depreciation is not allowed. And for corporations, the DPAD, the Section 189, was repealed, so that increased the PA taxable income starting point. Looks right now, the limitation of interest deduction will affect PA starting point. The NOL limitation will have no effect, as we mentioned. And then for full expensing provisions, it's a yes and a no, because 179 for corporations, Pennsylvania currently does follow federal, and if no other, anything contrary does not pass the legislature, it would continue to follow 179. And we already talked about bonus with Act 72, where it does not apply for corporations.
So, aside from federal tax reform, one of the other recent developments affecting state taxation is the Supreme Court decision on the case of Wayfarer versus South Dakota. Simply put, this ruling will allow states to require out-of-state online retailers to collect and remit sales tax on sales made into the state, even if they have no physical presence in the state. This decision is going to have a far-reaching impact on states, businesses, and individuals. So why is that? Well, for the past 25 years, since 1992, the case that has been followed by precedent, which is another Supreme Court case, was Quill Corp v. North Dakota. This decision essentially prevented states from collecting sales tax from retailers unless the seller had a physical presence in the state. And that physical presence satisfied the substantial nexus requirements that was set in previous court cases before that. However, the economy has changed since 1992, believe it or not. Many states wanted to challenge this rule, and that's exactly what South Dakota did. So back in 2016, South Dakota passed this law, which is the $100,000 annually or at least 200 separate transactions, which is listed there, and put in the provision that allowed them to sue any out-of-state sellers that were not in compliance with the law. Part of the reason for this is that South Dakota, along with many other states, wanted that Quill decision to go on trial because it prevented them from collecting tax on those online retailers that didn't have a physical presence. So sure enough, they sued 3 different large online retailers for noncompliance, including Wayfarer, and that's why I'm discussing this today. As far as the specific circumstances, part of the reason that the Supreme Court allowed the South Dakota rule was because of some of the safeguards that were in place. And these are the first 3 bullet points on the slide. So first off, you see that bright line rule there. That is simply a safe harbor for small retailers relating to the $100,000 and the 200 transactions, so that a retailer that has only a few sales into the state isn't going to have this burden of complying with the new law. The second one there, the retroactivity, or the no retroactivity, I should say, is simply that they're not going to go back now if the rule's overturned and say, okay, we want to collect all of the taxes that are within the statute of limitations because you didn't pay them, even though companies were simply following the rules that were previously in place. So that was one provision that the Supreme Court felt better about passing it because they knew that South Dakota was not, because of their laws, they would not be able to collect retroactively. And then the third one there is that South Dakota adopted the Streamlined Sales and Use Tax Agreement. This provides for uniform rules to taxation. There's about 20 or so states, I believe, that are part of the Streamlined Sales and Use Tax Agreement. And it simply makes administration easier for businesses. So just another safeguard that if this rule is going to be overturned, it made things a little bit easier in the follow-up. Some other considerations there then, economic nexus. So what constitutes substantial nexus? Economic nexus means that a company is benefiting from the state economically, and therefore they should be required to collect and remit the sales tax. The fair playing field, that relates to in-state retailers versus online retailers. So the obvious logic there is, if I'm in a brick and mortar store and I have to collect tax and charge my customers more because of it, why should I have to do that and an online retailer doesn't have to do that? And then complexity of compliance. Basically, simply said, we don't want this to be too burdensome to companies and potentially harm interstate commerce by making companies not want to enter a state because it's too burdensome to then have to collect tax. And then finally, there was an argument that this is something that should be handled by Congress. But the obvious counter-argument to that is that, well, it's been 25 years. They haven't done anything. So obviously, somebody needed to step in at this point.
And the interesting thing about this decision, none of these requirements or the things that the Supreme Court highlighted in this as being reasons that they thought this was a fair tax, none of them are necessarily, are they saying, are required, but there were things that they thought were good reasons why this tax should be honored in this collection requirement should be honored in South Dakota. So some of these states, some of them that aren't even on that list, but the fact that South Dakota has one rate for all products, they have a very easy collection administration process in the state, even offering free software to collect on this tax. Some states, other states, as they kind of want to put their guidelines out based on this decision, some of those states don't have easy taxes from a sales tax collection standpoint, so they might still not be constitutionally correct based on this Wayfarer decision. So it'll be very interesting as states are trying to hop onto this to see what actually becomes of this, and are there going to be actually true bright-lined tests that come out of this?
Right. And that was definitely something I noticed as well in reading the opinion, was that a lot of the reason that this was able to be overturned was because of those safeguards that they had in place and because of those specific circumstances. So it's something that might be interesting going forward to see what other states try to do, because, where is that line now? If it's not physical presence, where does it stop? It seems like this law that they decided on seemed reasonable to the Supreme Court, but where exactly does it end?
And with Quill, they had really, when the Supreme Court came out with the decision, they were hoping Congress would actually jump on board and do something at that point. And 25 years later, nothing has happened. And then this case comes out, and we're still asking Congress, can they act on this? New Hampshire, I think some people might be aware that they don't actually collect sales tax in New Hampshire. There's no sales tax reporting requirement. They put out a bulletin the other day that said, we don't want these other states taxing our residents that are selling into South Dakota or other states that are coming out with similar economic nexus laws. In fact, those states, before they can assert nexus or a requirement to collect sales tax on our residents, they're going to have to come to us and seek a legal opinion from us to be able to do that, which clearly violates the business clause of state business across the nation for the U.S. Constitution. But maybe by doing that, they're actually pressing Congress. You need to come in and do something about this. So I thought that was a very interesting technique by New Hampshire.
So this next chart we have here shows which states assert sales and use tax jurisdiction on the basis of economic nexus. Again, whether the company is benefiting from the state economically. And you can see Pennsylvania is one of those states that does. But you'll also notice there's a lot of notes there at the bottom. And what most of those notes say is that a lot of states don't actually require collection, but require some sort of notice and reporting at a minimum. And then we'll get into exactly what Pennsylvania's rules are on that, because that is one of the states that requires those notice and reporting requirements. So since it hasn't been very long since this decision, it was released on June 21st, we will have to wait and see how the states react. Several have already imposed requirements similar to South Dakota. So as we discussed, they said, okay, South Dakota's rules look pretty good. So a lot of the states looked at that and said, well, let's just do what they did. So it'll be interesting to see what states try to push the limit even further on that. As you can see here, Pennsylvania requires remote sellers to either collect and remit the tax or comply with the notice and reporting requirements. So it has on there remote sellers, marketplace facilitators, or referrers with aggregate sales of $10,000 or more in the prior calendar year, and goes into the requirement to either file an election to either collect the tax or comply with the reporting requirements.
And we talked about that Wayfarer bulletin coming out by the Department of Revenue. We don't expect there to be anything significant coming from that. We've already heard from the state legislature and Department of Revenue. They're not even anticipating any additional funding from the Wayfarer decision because they feel they effectively handled this with last year's budget by making these marketplace facilitators essentially register. The use tax and notice and reporting requirements were so burdensome that really the easier option was just to collect sales tax from your customers. So probably not going to be a big windfall from the Wayfarer decision for Pennsylvania.
Right. And that was mostly the purpose of it at the time, was because Pennsylvania said, well, if you don't collect tax, you have to do these reporting requirements. And they're so burdensome that really the point of it was so that businesses would just start collecting and remitting the tax. As far as the overall effect of this decision, the decision will likely require additional filing requirements for businesses that haven't had to file in certain states before. But there's also the potential for this to be applied to other tax types, such as income tax. If they're saying you don't need a physical presence for sales tax, then what's it going to be for other taxes going forward?
Yeah, I just got back from a national state and local tax conference in Chicago earlier in this week, and that was a major fear. That was on the minds of a lot of individuals. People even came in from the Illinois Department of Revenue and talked about their position, and they said economic nexus based on this decision for income taxes, basing it on Wayfarer, that was not out of the question. The states could really draw similarities and be able to apply that on an income tax basis as well. The other thing that is not being talked about much is the $100,000 parameter here. It's believed to be total sales, not just taxable sales. So even wholesalers selling to these states that are not needing to collect necessarily sales tax because they're not selling at retail, but there's an exemption certificate requirement, a resale certificate that now they need to start collecting, whereas they might have been just collecting for their home state in the past. And where it gets really dicey is when if they're primarily a wholesaler but selling maybe a little bit direct to customers. So maybe let's say they have 95,000 of wholesale sales into a particular state and only 10,000 of retail sales. Well, that puts them over the 100,000 total sales parameter. So they might still need to register in that case.
So our next chart here, we have the notice and disclosure requirements. So again, going back, this is relating to what we said about PA, where there's several states that have this notice and disclosure requirement where although they might not require retailers to collect, they have this other requirement that essentially suggests that they collect the tax.
So we're at 3:00 here at the end of our webinar, and there's a couple questions that came in that I want to address. So I'm not going to spend more than 2 minutes on this, but as I mentioned, this one of my favorite parts each year is the Tax Foundation's annual state rankings. You can see there on the map, it's based on a number of factors, depending on how their structure's set up, the tax rates, etc. Pennsylvania is now 26th, right around average in their ranking. They were 24 2 years ago, so back in 2017. You can see the overall ranking, what that entails for Pennsylvania. Their 26th ranking. Corporate tax rank is 44th, which is no surprise there with the high tax rate and restricted NOL. The other tax types, not any changes in the major ones there, individual and sales tax. We haven't had many changes in the law the last few years, and relatively low rates nationally. But if you look at that chart there at the very bottom, it makes me think of that saying, if you're being chased by a grizzly bear, you don't have to be the fastest person. You just have to be close by to someone who's at least slower than you. So you look at Pennsylvania there, that they're kind of ranked average across the nation, but of the states that surround us, the large ones, they're all ranked, we're outranking them, which is a good thing, of course. I think New York and New Jersey are not a surprise there, rounding at the bottom of the 50 states. And quickly, New Jersey hasn't gotten any better. I can tell you they'll probably be 50 next year because their budget just passed beginning of the month here, and they didn't quite catch the tax reform fever. They saw that the federal corporations are paying less. It gives us an opportunity to close our shortfall in our state budget and increase tax rates. So they instituted a 2.5% surcharge on corporations making more than $1 million of taxable income in New Jersey, which brings their rate up to 11.5% for that tax. So just a few questions that came in. So not surprisingly, it's mostly about 1099 withholding. One question here is if it's a PA headquartered business, we're a PA headquartered business, we hire an independent contractor, an individual to perform work on a job in Maryland and pay him over $5,000. Do we need to withhold under this new rule? And the answer is no. It's just on PA source income. So if the job is actually being performed, just because you're a PA business, but if you're having a job that's being performed for your customer outside the state, that's not considered PA source income. Another question was on director's fees. And I've gotten this question a good bit, and it probably because it hits that parameters, or a few jobs a year that are being done by these directors that are coming in and get paid, and it's not unreasonable for that to get paid over $5,000. So how do you allocate that? What's considered PA source versus non-PA source? If it's a PA business, they're going to most likely hold their board meetings in Pennsylvania. But a lot of these directors, so they seem to move to Florida, it seems, as they retire. And, so how do you allocate that? You have committee meetings, of course, that might be on phone calls where the individual's in Florida, or they might be doing prep work for the board meeting before coming up. We've asked the Department of Revenue that directly through the PICPA. Fortunately, haven't gotten extremely good clarifying information from that. They refer us to a statute based on cost of performance and how that's allocated based on days. My recommendation is each board member, and this might be asking a lot sometimes, but it's going to be based on their time spent overall. It would be my position, and it's by a day basis. So if they can formulate that they've worked on a certain amount of work in preparation for the board meeting on a given day, have a committee meeting each month that they call into, and maybe a board meeting every other month. Most of that PA source payments would be outside of, or most of those payments would be considered outside of Pennsylvania, and you'd only be withholding on the amount that's considered Pennsylvania amounts. The last question there: how does a CPA gain access to the e-tides to get their clients' tax account statements? It's a pretty easy way of doing it. You just have to set up an e-tides account as a practitioner yourself. Then you enter some client-specific identifying information, and then the client then needs to log in and approve your access. Unfortunately, there's different accesses for getting access to the statement of accounts, or different approvals, I should say, needed for getting the statement of accounts versus getting Department of Revenue correspondence. Hopefully they bring those together, so you just need to get one approval going forward, though.
Thank you once again for joining us for this webinar recap produced by McKonly and Asbury. We hope you join us for our future webinars. You can stay connected to us and learn more about all of our upcoming events by visiting us at www.macpas.com. Thanks again and have a great day.